Throughout my career, I've learned a simple rule. Major crises don't begin with panic. They begin with complacency. In 1992, during what became known as Black Wednesday, most believed the European exchange rate system was sustainable. The pound seemed protected. There was institutional confidence. There was political consensus. But the fundamentals were misaligned. And when fundamentals clash with monetary policy, the market wins. It always wins. Today, when I look at 2026, I don't see an isolated event about to explode. I see something more dangerous, a set of structural weaknesses that are being ignored. We are possibly approaching a new liquidity trap, and Britain is less prepared than it appears. What worries me is not just the level of public debt. It's not just the anemic growth. It's not just the demographic pressure or the post-Brexit challenges. It's the combination of all of this in a global environment that is also weakening. A liquidity trap occurs when the central bank loses effectiveness. It cuts interest rates. It expands the balance sheet. It injects liquidity, and yet growth does not respond structurally. Credit does not translate into productivity. Money circulates within the financial system, but it does not generate sustainable real expansion. The UK has already experienced more than a decade of aggressive stimulus since 2008. The Bank of England expanded its balance sheet massively. During the pandemic, liquidity was expanded again. The system became accustomed to low interest rates. When inflation forced monetary tightening, cracks appeared, especially in the sovereign bond market. That was a technical warning, but few treated it as a structural signal. I don't analyze events in isolation. I observe patterns. And the pattern I see now is this: weak structural growth, high debt, dependence on foreign capital, and limited productivity. This combination creates silent vulnerability. If global growth slows by 2026, and there are signs of convergence in that direction, central banks may be pressured to cut interest rates again. But with high levels of public and private debt, the effect of these cuts may be minimal. And that's where we fall into the trap. When monetary policy loses its potency, the economy enters a state of dependency, and dependency reduces room for maneuver. What I want you to understand in this opening is simple. It's not about predicting an imminent collapse. It's about recognizing that the UK may be entering a prolonged cycle of compressed growth and limited real returns. And cycles like that are particularly dangerous for those who need to preserve wealth. Now let's delve deeper into the concept. Because if you don't understand the mechanism, you won't understand the risk. A liquidity trap doesn't start with panic. It starts with excessive stimulus that loses effectiveness over time. It works like this. The central bank lowers interest rates to stimulate credit. Companies take out loans. Consumers consume. The economy reacts. So far, everything is within the traditional logic. But when accumulated debt becomes too high, each new interest rate cut has a marginally smaller impact. The system is already saturated with credit. This is exactly what happened in Japan after the 1990s. The Bank of Japan reduced interest rates to near zero, expanded its balance sheet repeatedly, and yet growth remained structurally weak for decades. This happens because the problem ceases to be liquidity and becomes productivity. Liquidity is fuel. Productivity is the engine. If the engine is weak, increasing the fuel won't help. Now look at the United Kingdom. After the 2008 crisis, the Bank of England implemented massive quantitative easing programs. During the pandemic, it expanded them again. The result was a financial system highly dependent on low interest rates. This type of dependence creates distortions. Asset prices rise, corporate debt grows, the real estate market expands, but structural productivity growth does not keep pace. When inflation appeared and interest rates needed to rise, tensions arose. This is natural in leveraged systems. The central point is this: if in 2026 there is a global slowdown and the central bank is forced to cut interest rates again, the impact may be limited, because the problem will not be the cost of capital. It will be confidence, productivity, and fiscal structure. And here's where a critical element comes in: expectations. If companies and consumers believe that future growth will be weak, they don't invest aggressively, even with low interest rates. They prefer to reduce debt, preserve cash, postpone expansion. This collective behavior neutralizes monetary stimulus. It is at this point that money begins to circulate only within the financial system. It supports asset prices but does not generate robust real growth. This creates an environment of seemingly stable financial returns but mediocre economic growth. For more experienced investors, this is dangerous because the perception of stability masks a gradual erosion of purchasing power. The liquidity trap isn't explosive, it's corrosive. And when we combine this risk with high public debt and a constant need for external financing, the picture becomes more delicate. What we need to analyze next is how this dynamic interacts with the specific vulnerabilities of Great Britain, because the trap in isolation is already challenging. But when it encounters structural vulnerabilities, the risk ceases to be theoretical and becomes strategic. Now we need to connect the concept to the British reality. A liquidity trap is problematic in any developed economy, but it becomes particularly delicate when the country presents clear structural vulnerabilities. And the United Kingdom today has three that deserve rigorous attention. First, high public debt combined with limited potential growth. When the debt to GDP ratio rises and structural growth slows, fiscal space decreases. The government becomes increasingly dependent on market confidence to finance deficits at reasonable costs. If nominal growth does not accelerate sustainably, debt dynamics become sensitive to small changes in interest rates. Second, persistent current account deficit. The United Kingdom depends on foreign capital to finance its consumption and investment patterns. This means that international investors are an essential part of the system's stability. If the perception of risk increases, capital may simply seek alternatives. Unlike economies with structural surpluses, Britain does not have a sufficient natural cushion of domestic savings to absorb prolonged shocks without exchange rate adjustment. Third, weak productivity over the last decade. Without consistent productivity growth, real income growth becomes limited. This reduces the economy's ability to grow above the cost of financing its debt. And without real growth, monetary stimulus tends to generate more asset inflation than genuine economic expansion. I've seen this pattern before. In 1992, during Black Wednesday, the problem was the mismatch between exchange rate policy and economic fundamentals. Today, the exchange rate regime is different, but the principle remains. When fundamentals and expectations conflict, the market forces an adjustment. If global growth slows in 2026 and the Bank of England is pressured to cut interest rates again, the impact may be limited. At the same time, aggressive cuts could put pressure on the pound in an environment dependent on foreign capital. This creates a classic dilemma. Maintaining relatively high interest rates to defend the currency risks deepening the domestic slowdown. Cutting interest rates to stimulate growth could weaken currency confidence. If global growth slows in 2026 and the Bank of England is pressured to cut interest rates again, the impact may be limited. At the same time, aggressive cuts could put pressure on the pound in an environment dependent on foreign capital. This creates a classic dilemma. Maintaining relatively high interest rates to defend the currency risks deepening the domestic slowdown. Cutting interest rates to stimulate growth could weaken currency confidence. Because when macroeconomic room for maneuver decreases, so does the tolerance for error. And in structural cycles, surviving with discipline is more important than seeking extraordinary returns. No macroeconomic analysis is complete if it remains confined to the borders of a single country. The United Kingdom operates within a highly interconnected global system. And what worries me regarding 2026 is not only British domestic fragility, but the potential convergence of slowdowns in the world's major economies. Let's start with the United States. The world's largest economy has been operating with high fiscal deficits and growing public debt. In previous cycles, robust growth helped to dilute this burden. But if growth slows while the cost of debt remains high, American fiscal space also shrinks. This reduces the global capacity to absorb shocks. In continental Europe, the picture is structurally challenging. Weak population growth, limited productivity, and regulatory rigidity hinder sustained acceleration. China, meanwhile, faces a complex economic transition with a slowdown in the real estate sector and significant demographic pressures. When three major economic poles show signs of weakening simultaneously, global growth tends to converge to lower levels. It is in this environment that central banks begin to act in a coordinated manner. If the slowdown is confirmed, we will see synchronized interest rate cuts. But here is the crucial point. When the entire world cuts interest rates simultaneously, in a context of high debt, the multiplier effect is reduced. Monetary stimulus loses marginal potency. This creates a classic scenario of a liquidity trap on a global scale. For the UK, this is particularly relevant. If all major economies are weakening, external demand also slows, Exports do not compensate for domestic weakness. Capital flows become more selective. And when capital becomes selective, it seeks solid fundamentals. If international investors need to choose where to allocate resources in a more restrictive global environment, they will analyze potential growth, fiscal stability, and institutional credibility. The United Kingdom remains a sophisticated and relevant economy, but its structural differential has narrowed in recent years. Modest potential growth and high debt reduce the relevant economy. If global growth slows by 2026 and major central banks enter a new cycle of easing, the UK could face an uncomfortable combination: monetary stimulus with limited impact and increased competition for international capital. This is an environment where real returns tend to be compressed for extended periods. It's not a dramatic headline scenario. It's a scenario of slow structural adjustment. And for those who are overly domestically positioned, this can represent significant risk. Macroeconomics isn't about predicting catastrophes. It's about identifying when the structural environment ceases to be favorable. What I see today is a global system heading towards lower potential growth, with increasingly ineffective economic policy instruments. When this happens, preserving capital ceases to be a strategic option and becomes a rational necessity. If you want to understand the true health of a developed economy, don't start with the stock market, start with the sovereign bond market. Government bonds are the backbone of the financial system. They price in fiscal risk, inflation expectations, and institutional credibility. And when something starts to deteriorate structurally, that's where the first signs appear. In 2022, we saw an extremely revealing episode in the United Kingdom. The gilt market suffered a severe shift after the announcement of poorly calibrated fiscal policies. Pension funds using liability-driven investment (LDI) strategies faced a chain reaction of margin calls. Liquidity evaporated rapidly. The Bank of England had to intervene urgently to stabilize the market. This event was not just an isolated political mistake. It exposed something deeper: the sensitivity of the British financial system to abrupt interest rate movements. When a sovereign market needs intervention to avoid technical collapse, it reveals structural leverage and excessive reliance on interest rate stability. Now project this to 2026. If global growth weakens and the UK faces a domestic slowdown, the government will likely be under pressure to expand spending or sustain stimulus. This means greater debt issuance. At the same time, if international investors are more cautious globally, the demand for this debt may require a higher premium. This creates tension. Higher interest rates put pressure on growth in public finances. Lower interest rates can put pressure on the currency if fiscal confidence is questioned. This is the dynamic that worries me. In liquidity trap environments, central banks cut interest rates. But if the market starts demanding a higher fiscal premium, the central banks may be forced to choose between credibility and growth. It's a classic dilemma of highly debt economies. The illusion of stability often precedes periods of repricing. Before Black Wednesday, there was also a sense of control. The pound seemed protected. The system seemed organized. But when confidence is tested, adjustments are swift and nonlinear. What the gilts episode showed is that the UK is not immune to structural stress. It has a sophisticated yet highly integrated and sensitive financial system. In a scenario of compressed growth and reduced monetary policy effectiveness, the bond market may once again become the decisive barometer. And for experienced investors, ignoring signals in the sovereign market is a strategic mistake. Because when the foundation of the financial system begins to fluctuate, everything else reacts. What we need to understand now is how to transform this macro reading into rational positioning, not reactive, but disciplined. Now we need to answer the central question: why could 2026 become a turning point? Monetary cycles are not random. They follow relatively predictable patterns. After a period of aggressive stimulus comes excess. After excess comes inflation. After inflation comes tightening. And after prolonged tightening, a slowdown often follows. We are at the stage where monetary tightening has already produced a slowdown in several developed economies. If this slowdown consolidates globally, by 2026, central banks will begin cutting interest rates again. And here lies the structural problem. If interest rate cuts occur when public and private debt levels are already high, the marginal effect tends to be smaller than in previous cycles. Highly indebted companies prioritize deleveraging. Pressured consumers prioritize risk reduction. Governments face fiscal constraints. Stimulus does not automatically translate into growth. This is the classic liquidity trap environment. The Bank of England can cut interest rates. It can expand its balance sheet again. But if business confidence is weakened and productivity remains constrained, the real impact will be contained. Furthermore, there is a critical variable: credibility. If markets begin to perceive that monetary policy is being used to accommodate fiscal fragility, the risk premium could rise. This manifests itself in higher long-term interest rates or currency pressure. This tension between the short term and the long term is crucial. In the short term, cutting interest rates can alleviate pressure on mortgage lending and corporate financing. In the long term, it can raise questions about macroeconomic discipline. Countries with strong structural growth can absorb this dynamic more easily. The United Kingdom currently has modest potential growth. This reduces the margin for error. Another relevant point is population aging. Economies with mature demographics tend to exhibit less dynamic consumption and a lower appetite for productive risk. This amplifies the effects of the trap. If in 2026 we have a synchronized global slowdown, lower interest rates, and weak structural growth, we will be facing a scenario in which monetary policy loses a significant part of its historical effectiveness. And when traditional instruments lose power, the market begins to reassess assumptions. I don't trade based on specific dates. I trade based on probability and asymmetry. Today, the probability of a prolonged cycle of compressed growth in the UK is higher than many realize. And the asymmetry lies in the fact that much of the capital is still positioned as if the structural environment were similar to that of the last decade. No, it's not. We are entering a phase where real returns will be more difficult, volatility may increase, and strategic discipline will be a competitive differentiator. And it is precisely in this type of environment that unprepared investors make structural mistakes, while disciplined investors preserve capital and wait for better asymmetries. At this point, the natural question is, how do I think about positioning myself in this scenario? I don't start by trying to predict the exact month of a turning point. That's irrelevant. What matters is identifying asymmetries, situations where risk is mispriced relative to potential return. Today, the asymmetry I observe in the UK lies in complacency regarding structural growth and long-term fiscal sustainability. Many investors still assume that the structurally low interest rate environment will return and restore the same asset appreciation pattern of the previous decade. But this premise ignores an essential factor: the debt level is significantly higher and productivity has not accelerated. This alters the system's equilibrium point. When an economy enters a liquidity trap, real returns tend to be compressed. Fixed income offers nominal protection, but may not protect purchasing power. The stock market may rise, but with multiples more sensitive to weak growth. Therefore, the classic mistake is to maintain excessive concentration in domestic assets, believing that the system will always adjust smoothly. History shows that adjustments are rarely linear. In the Black Wednesday episode, the repricing of the pound occurred abruptly when confidence broke down. Today, the exchange rate regime is different, but the logic of confidence remains. If international investors begin to demand a higher premium to finance British deficits, the adjustment may occur via exchange rates, via long-term interest rates, or via both. As a macro investor, I think in terms of 3 layers of protection. First layer, real liquidity. Cash or equivalents in strong currencies that allow for strategic flexibility. Liquidity is not return, but it is optionality. Second layer, geographical diversification. Assets excessively concentrated in the United Kingdom increase exposure to specific fiscal and monetary policy risks. Third layer, exposure to assets with the capacity to preserve real value over time. Global companies with pricing power, strategic sectors, and real assets. This is not about adopting a permanent defensive posture. It's about recognizing the phase of the cycle. In cycles of productive expansion, calculated risk is rewarded. In liquidity trap cycles, strategic prudence tends to preserve capital. Another important point is emotional discipline. When growth is weak, markets alternate between euphoria and short-term pessimism. This noise can lead to misguided decisions. The experienced investor needs to operate with a structural, not reactive horizon. If 2026 marks a consolidation of compressed growth and reduced effectiveness of monetary policy, the key difference will not be in predicting headlines. It will be in already having a resilient structure before repricing. Macroeconomics is about advanced preparation, and right now, preparation is worth more than aggressiveness. If we accept the hypothesis that we are heading towards a liquidity trap environment by 2026, the question ceases to be theoretical and becomes practical: how to structure wealth in this context. First, it's crucial to understand that historical average returns may not repeat themselves in the same way. The last decade was marked by aggressive monetary expansion, rising multiples, and abundant liquidity. This environment favored broad appreciation of financial assets. But when liquidity ceases to generate real growth and only sustains prices, the risk of return compression increases. In environments of financial repression, when real interest rates remain low or negative for extended periods, purely financial assets tend to offer limited protection of purchasing power. Historically, real assets demonstrate greater resilience in these cycles, not through speculation, but through their ability to preserve intrinsic value. This includes global companies with strong pricing power, access to international markets, and solid balance sheets. Companies capable of adjusting prices in intermittent inflationary environments tend to protect margins better than domestic businesses that are highly sensitive to the UK's internal cycle. It also includes exposure to strategic global sectors, energy, natural resources, and critical infrastructure that have structural relevance regardless of the local monetary cycle. Another essential element is currency diversification. If the UK faces compressed growth with a need for recurring stimulus from the Bank of England, the pound could experience periods of pressure, not necessarily collapse, but increased volatility. Keeping part of one's assets exposed to currencies of economies with more robust fiscal fundamentals reduces concentrated risk. Furthermore, strategic liquidity remains a powerful tool. Liquidity should not be seen as inefficiency. In cycles of structural uncertainty, it represents the ability to act when clear asymmetries arise. In times of abrupt repricing, those with liquidity buy quality assets at a discount. A common mistake in weak growth environments is seeking excessive returns to compensate for frustration. This often leads to an unnecessary increase in risk. Macroeconomic discipline means accepting that certain cycles are more geared towards preservation than aggressive expansion. If 2026 marks the consolidation of a period of limited structural growth, the primary objective ceases to be maximizing nominal returns and becomes preserving risk-adjusted real returns. This is not pessimism. It's adaptation. Cycles change, structures change, incentives change. The investor who recognizes structural change before most don't need to predict every market movement. They simply position their capital in a way that is consistent with the new reality. And at this moment, consistency demands strategic prudence, intelligent diversification, and a rigorous focus on structural quality. Now, I want to speak directly to you who have already built wealth over decades. The biggest risk in this cycle isn't short-term volatility. It's not an alarmist headline. It's not a negative quarter. The biggest risk is silent erosion. In a liquidity trap, the system doesn't implode. It slows down. Real returns are compressed. Nominal interest rates may fall, but intermittent structural inflation erodes purchasing power. If you're 10, 5, or fewer years from retirement, you don't have the same recovery horizon you had at age 35. This is the critical point. During periods of robust growth, time is an ally. In prolonged cycles of weak growth, time can become an adversary if the portfolio is poorly structured. The UK, facing modest potential growth and high public debt, could experience several years of limited real returns if the liquidity trap takes hold. If the Bank of England is forced to maintain structurally low interest rates to support economic activity, domestic fixed income assets may offer acceptable nominal yields, but real returns below accumulated inflation. At the same time, equity markets may exhibit high volatility in an environment of weak growth and squeezed margins. This creates a scenario where the traditional buy and hold exclusively domestic strategy may not be sufficient. Another factor is the implicit currency risk. If international confidence in British fiscal balance is questioned at any point, as we saw on a different scale on Black Wednesday, adjustments may occur via currency or via financing costs. Even without an abrupt crisis, the simple increase in the risk premium can impact the valuation of local assets. For investors over 45, the priority should be resilience. Resilience means a structure capable of withstanding prolonged periods of low growth, currency volatility, and compression of real returns. This requires strategic discipline. Reduce excessive domestic concentration. Maintain sufficient liquidity to weather adverse cycles. Prioritize quality over speculation. The most common mistake in the final stages of a cycle is seeking high returns to compensate for recent setbacks. This behavior usually increases risk precisely when the margin for error decreases. Capital preservation is not a permanent defensive posture. It is a rational adjustment to the macroeconomic environment. If 2026 marks the consolidation of a more difficult structural cycle, those who adjusted their structure before the repricing will be protected. Those who ignored the signals may discover too late that compressed growth and intermittent inflation are silent enemies, and silent enemies are the most dangerous. We've arrived at the crux of the matter. If 2026 marks the consolidation of weaker global growth, reducedly effective monetary stimulus, and high structural debt, the UK could enter a prolonged period of compressed real returns. This doesn't mean collapse, it means constraint, and macroeconomic constraint demands strategic discipline. Throughout my career, I've learned that big mistakes don't happen because investors lack information. They happen because they ignore structural change. Before Black Wednesday, there was overconfidence in exchange rate stability. Before the 2008 financial crisis, there was overconfidence in credit stability. Today, I see excessive confidence in the idea that central banks will always be able to restore growth with interest rate cuts. But monetary policy doesn't create productivity. It doesn't correct demographics. It doesn't resolve structural fiscal weaknesses. If the Bank of England is forced to cut interest rates again in an environment of anemic growth, the impact may be limited. And if the market begins to question fiscal discipline, the adjustment may occur through a higher risk premium. This is the typical liquidity trap environment: continued stimulus, weak growth, and compressed real returns. Given this, my philosophy remains simple. First, survive, then thrive. Survival means maintaining strategic liquidity. It means real international diversification. It means exposure to quality assets with the capacity to preserve value. Thriving will come when clear new asymmetries emerge, and they always emerge after periods of adjustment. A disciplined investor doesn't try to predict every fluctuation. They build a structure capable of weathering cycles. If you're 45 or older, your priority shouldn't be maximizing speculative gains. It should be protecting purchasing power over the next decade. Macroeconomics is a game of patience, structure, and risk management. If you want to continue learning how to interpret systemic cycles, identify asymmetries before most people, and protect your assets in complex environments like this, subscribe to the channel now. The coming years will not reward overconfidence. They will reward discipline.